Now, before we get into the actual calculations, let me just re-emphasize that why hedge fund compensation structures, and this is also true for private equity, why they are designed to reward early involvement, larger investments, and lockup periods. So, we discussed that if somebody gets involved early, they might get a benefit of lower fees. But why is that? So, to understand why a hedge fund would want to do that, you have to understand that in addition to leverage, what else can magnify? So, in addition to leverage, what else can magnify the losses for the hedge funds? And hedge funds usually invest in relatively illiquid securities. I mean, if they're just going to buy stocks of Apple, Google, Microsoft, the investors can do that themselves, right? So hedge fund would look for something more rare, a diamond in the rough, maybe invest in some biotech stock, which is not necessarily going to go up immediately. It might take some time for it to go up. It might even go down before going up. And if it is, let's say, performing poorly, and investors get a little worried, and what they say is, okay, please give me my money back because they're afraid it might go down even more, then that is something that has to be stopped or at least avoided as much as possible, because that's the time you have to wait it out, usually, if you've selected the investment very carefully, and then eventually it performs. So now, if you've got multiple investors in a hedge fund and one of them is kind of freaking out and saying, okay, I want out, then if they force the hedge fund to sell at that lower point, it's going to be bad for the other investors in the hedge fund as well, right? So now, how do hedge fund managers deal with this? See, first of all, we're going to have a lockup period that whoever are the investors coming in, they should know that you're not going to be able to take your money out for a certain number of years. This is to ensure that the hedge fund manager gets sufficient time to implement the strategy. Even after the lockup period is finished, there's going to be a notice period. So even after the lockup period is finished and you can take your money out, but if you do want to take your money out, you're going to have to give a notice. And even then, you could have a redemption fees. So let's say lockup period is finished, market is down, you give a notice, you force the manager to sell stock at bad prices, right? This is not good for the remaining investors. So what the hedge fund manager will do is charge you a redemption fees. So clearly, alternative investments are not for everybody, right? These are for sophisticated investors who have the ability to wait it out during tough times. Now let's get into the return calculations. So how does the hedge fund typically structure the compensation? We're going to start off with the most basic part and then slowly add various variations of this. And I will take you through multiple questions so that you understand what those variations are and how the calculation is done from them. And then on your own, you can log into the CFA learning ecosystem, or you can use our question bank and try a lot more questions, right? But the questions that I will be taking you through, I'm not going to ask you to solve them because it's not very practical to expect you to be able to solve them without actually showing you how it's done. So I'll show you how it's done, and then you can use other questions to just make sure you've gotten the concept. Now let's start with the most basic part, 2 and 20. So let's say you put in 100 million in the hedge fund, right? And it generates a 20% return for you. So this becomes 120 million. Now the hedge fund is going to do two things. Number one, they're going to take a management fees. So the first 2 is a reference to the management fees, and the second 20 is a reference to the performance fees. We also use multiple other names, incentive fees or carried interest. So private equity usually call this carried interest. Hedge funds call it performance fees. You might even see the word incentive fees being used, right? So don't get confused if you see any of these performance fees, incentive fees, carried interest, they all mean the same thing. And what that is this profit that they've made for you, the extra 20 million, they will take 20% of that, right? So that's what the 20 is for. And they will also take 2% of the initial invested amount, which is the asset under management. So 2% is the management fees, and the 20% is what you call the performance fees or the incentive fees or the carried interest. Now, what's the point of taking these two separately? Every year they're not going to be in profit, so there's not going to be a performance fees every year, but there's going to be expenses for the fund manager. So that's why the management fees is there. Regardless of the profit, a little bit of the percentage of the assets under management is given to the manager so that they can manage their expenses. And of course, when there is a profit, then they take a certain percentage of the profit, and which is usually much bigger, right? So, I mean, if you see what's going to be 20% of 20 million, well, that's going to be 0.2 into 20, and that is 4. Whereas this is going to be 2% of 100, which is 2. Well, it's not much bigger, but it can be much bigger if the profit is much bigger, right? Anyhow, so this is done to align the interest of your fund manager with that of the investor. Because if you only give them a fixed fee, then the fund manager is not going to try hard and generate a profit. So if you give them a performance fees as well, so then what will end up happening is that they get the 2% of the assets under management, which is 2 million, right? 2% of the assets under management. And they also get that 4 million, which is 20% of the profit that they generated for you. Sometimes what you also have is something called a fund of funds, and that means that, let's say, you don't know which hedge fund is giving this very nice return of 20%, and you're an investor and you don't know how to find the best hedge fund which is expected to give a good return of 20%, or even, let's say, 40-50%. I've seen hedge funds giving returns of 200% per year. So what happens is investors can then first invest in something called a fund of fund, and then that fund of fund goes and finds good hedge funds and invests in them. So then the investor pays a double layer fees, because first this hedge fund will charge their 2 and 20, right? And then the fund of funds will charge another 1 and 10. So the investor actually pays the fees twice. But it works out if the fund of fund is really good at finding the best performing hedge funds. And there's some other variations of all of this that can be there, and we'll talk about each one of them, and I will take you through the calculations for each one of them as well. Right. Before we get into the calculations, just a bit more high level stuff, that how do they sort of reward, how do these hedge fund compensation structures reward early involvement and longer lockup periods, etc. So let's talk about it, right? There's three ways that they do it, and let's talk about each one of them one by one. Starting with the fees based on liquidity terms and asset size. So liquidity term basically means longer lockup periods, because you're agreeing to a lower liquidity, willing to accept a lower liquidity, so they will give you a discount on the fees. If you are having a bigger investment, you can get a discount. So larger investors, so in terms of asset size, and also, as we discussed, in terms of liquidity terms, you can have that lower fees. Now, how is the paperwork done for this? So first of all these are LPGP structures, right? So whether the limited partners are the investors and the general partner is the manager of the fund. And let's say you've got a limited partner coming in, but this limited partner, let's call them 1 and let's call the other one 2. So this limited partner wants a special fees, a lower fees. They're willing to accept a lower rate. So what we can have with them is something called a side letter, right? And that's different from your normal agreement, the limited partnership agreement, which, of course, the limited partnership agreement is for all the investors, but then you can have a special amendment via a side letter for any special limited partner coming in who wants the lower fees. You can also have something called a founder's share, which means when the hedge fund is being formed and they want investors initially to help them, set it up, then they can offer them lower structures. Instead of a 2 and 20, you can offer them 1.5 and 10. That could be and typically is applicable to a certain cutoff threshold that you can't put all the money in. Maybe just the first 100 million will be at that lower rate, and then if you want to put more, that comes at the normal 2 and 20. What's recently happened is that you could even have investors not charge the management fees at all if the return is very good, right? So then the investors would say, okay, we'll just give you a very large percentage of the profit. Why they would want to do this, and why would the hedge fund manager agree to do this, is because if the profit is very big, let's say the profit is they double it, right? Let's say they double it and it goes from 100 to 200. So there's 100 million profit, of which 30% is obviously going to be 30 million, which is huge compared to if they just got that 1% fees, would be nothing. So this is done to incentivize and align the investors' interest with the manager, so that the manager works really hard and tries to generate a huge return. But at the same time, to sort of cover the expenses of the manager in down periods, and there is that 1% management fee. So instead of 2%, the manager will agree to a 1%, right? Just to have that bare minimum expense coverage, no matter what. And then the manager will just try to get that bumper return. Okay, let us now get into the calculations. And this is a very interesting calculation because here we're going to talk about waterfall types. Now, there are two waterfall types, European and American. American is also called a deal-by-deal structure. Now, hedge funds like this hedge funds, or I would say the fund manager, because even for private equity, this is relevant. So the fund manager would prefer this. Why? Because, see, this is a deal-by-deal structure. Maybe one deal is in profit, the other deal is in loss. So here, if it is an American style deal by deal, then what will happen is that the fund manager would get profit on the one which is in profit, and the one that is in loss will just have to wait. And then once that comes in profit, then you can get the profit for that. But in the European style, what will happen is that the whole fund has to come in profit, right? So if one is in profit and the other one is in loss, well, the fund manager is not going to get anything. And that's what you can see in this example, right? That you start off with 10 million in one company and 12 million in another company, right? This 10 million goes to 16, right? It generates a profit of 6, but that company B generates a loss. So if you're going to go for a European, you're not going to give any fees to the manager in terms of their performance fees, incentive fees, carried interest, because overall the loss is greater than the profit, right? So let me even show you. So in the European style, what happens is that because the loss is greater than the profit, so overall the fund has lost money, so there's not going to be any incentive fees, carried interest, performance fees, etc. Right? Now, in a deal by deal, the situation would be different because one of them is in profit and they would say, okay, I want a 20% of that profit, right? So the fund manager would definitely prefer a deal by deal. Right, let's have a look at a lot of different variations that we can have. So we're going to have the same case, but we're going to look at it 5 different ways. The case is initial investment 200 million, structure is 2 and 20, and return is 30%. So basically this 200 is going to go to 260 because 30% return means 60 million profit. So 200 plus 60 would be 260. Now, first we're going to look at just 2% of the 200 million, which will be your management fees, and 20% of that profit, additional profit of 60. Then we will look at if the incentive fees were calculated after deducting the management fee, right? So let me first show you these two and then I'll move on to the other three. So first, the number one, the most simple one, that okay, you started with 200, you ended up with 260, which means you've had a profit of 60. So there's two things that you're going to pay the manager. You're going to obviously pay them 20% of 60, which is your incentive fee. You're also going to pay them 2% of the either 200 million or 260 million. Now this is also very important. In the question, they will tell you whether the management fee has to be applied to the ending balance or the beginning balance, right? So this is important. So you have to check. And in the question, they will always tell you whether it is going to be applied, the management fees is going to be applied to the ending balance or the beginning balance. Whatever it is, you take the management fees amount and the incentive fees amount, you calculate the total fees, right? And which is coming to 17.2 in this case, and ending fund size minus all the fees gives you what is the remaining for the investor, and that will tell you, if you divide it by the original investment, that what was the return for the investor net of fees. So this is the situation where management fees and incentive fees are being calculated independently. Now, if the question says that the incentive fees will be calculated after deducting the management fees, what that means is that, okay, you went from 200 to 260, right? So there is a 60 million profit. But before we give you 20% of that 60 million, we're just going to deduct the management fees. Because the investor says that, hey, you're taking like management fees separately, but you're still asking me to pay you 20% on that entire profit. So that's not fair with me. So first you're going to take out the management fees from that profit amount, and then whatever is remaining, you can apply that 20% to that. And clearly the fees is lower here. Let me just take you back to the previous one. So in the previous one, the management fees was 5.2, but the carried interest or the incentive fee was 12. Now here, management fees is 5.2, but this has reduced from 12 to 10.9 because the amount of profit it is being applied to, the 20%, the amount of profit it is being applied to is lower. Right, you're deducting the management fees before calculating the profit amount on which that 20% will be applied. And obviously the investor's overall return is improving. And let me show you again. In the previous one, the return was 21.4 and now the return is 21.9. And watch how this improves further now. So now what's going on is that we're showing you how investors can make it more and more better for them. And if you're an investor, if you're representing the investor, how you can negotiate with the fund managers, right? So look, it has improved even further now. And how? I'll show you. So here they are talking about something called a hurdle rate. Now I want you to keep in mind that the hurdle rate could be a soft hurdle and it could be a hard hurdle, right? In the question they can tell you whether it is a soft hurdle or a hard hurdle. Now in this case, it's a hard hurdle. Hard hurdle, why? Because they're specifically saying fees are based on the returns in excess of 5%. What that means is, starting with 200, the first 5%, which is the first 10 million, is not going to be part of the profit on which the manager will receive any fees in terms of your incentive fees, right? Because that is the basic return that the investor has to get. So it's a hurdle that the manager has to cross. And not only is it a hurdle that the manager has to cross, it is a hard hurdle, which means any amount of profit up to that hurdle is not going to be included in the calculation of the incentive fee. Right? So from 200 to 260, that's 60 million. Not only do you minus the management fees, you also minus that hurdle amount. Now, if it was a soft hurdle, which in this case it is not, but if it was specifically mentioned in the question that it's a soft hurdle, then you don't need to minus that 10. All the fund manager needs to do in the case of a soft hurdle is that the return, overall return, which is 30 here, should be more than the hurdle rate. That the investor is getting a return which is more than the hurdle rate, and that's it. That's what the investor wants. They will pay that fees on the entire profit. Whether management fees has to be deducted or not, that is a separate thing. But this amount which is the profit between zero return and the hurdle rate return, will not be deducted if it is a soft hurdle. But if it is a hard hurdle, if it specifically says the returns, the fees will be based on returns in excess of the hurdle rate, then you need to deduct that as well. And the management fees is still the same. The incentive fees is now even lower, and therefore the investor's return is even higher. Now, moving to a high watermark, another very interesting thing. So see, what happens is, let's say you start off the fund with 200 million, you go to 260, and then the next year you have a loss, and then you have a profit. So let's say you have a loss and you come down to, let's say, 200 again, and then you go to 280. So is the investor going to pay you return from 200 to 280? The answer is no, because they've already paid you till 260. So why should they pay you again from 200 to 260, right? So this amount, this is what we call the high water mark, right? That you have to obviously cross where you were before, and then beyond that, whatever you get is something on which the fund manager deserves a profit. Now, the only tricky bit over here is that what is the amount of that watermark? Because what happens is, let me draw it again, that you start off with 200 and you're going to 260, right? So you're going to 260 and you would say, yeah, so now 260 should be my high watermark, because anything above that I want to pay more fees. You're right, that's true, but you're not really ending at 260, because what happens is when you pay the fees for the first year, you reset and come down a little bit because the fees is paid, and then let's say that amount is 250. So now 250 is the starting, and the investor has to go above 250 to so the fund manager has to go above 250 to ask for any fees, right? And let me demonstrate with an example. So again, starting with 200, 30% return, going to 260, and then what's happening at 260, which is linked with the previous question, that you paid the management fees, you paid the performance fees, and what does that amount come to? 14.16. So 260, if you paid 14.16 fees, what was the ending balance? It is going to be 260 minus 14.16, so 245.84, right? And then what's happening after that is that, they've taken 17.2 million and this one is 14.16. So now they are taking the first one. They are taking the first case, that if we are having starting with 260 in the first year, so you start with 200 going to 260, and then you pay that fees of 17.1, which is the 5.2 million management fees and the 12 million incentive fees, where you don't deduct the management fees before calculating the incentive fees. You don't even deduct the hurdle rate, right? So if you pay 17.2, this comes down to, so let me minus from 260, 17.2, so this is 242.8. Now this becomes the watermark. If there is a clause that there is a watermark, now the investor needs a return above it to pay any more fees, and if you're going below it, then there's not going to be any more fees. Now let me bring you back to question number 4, and this 242, that's the 242 where it's coming from, that they started with 200, went to 260, then paid fees of 17.2, and the first year was closed with the balance at 242.8. Now if it goes above, then there's going to be more fees incentive, or if it goes below, there's not going to be any incentive fee. Management fees will still be there. So let's say they end the second year at 220. So there will be fees, management fees on that 220, 4.4, right? And will there be any incentive fee? Let's check. Is 220 higher than the watermark? The answer is no, right? So you ended up somewhere over here, and after the second year. which is lower than the high water mark. So there's going to be no fees as far as incentive fees is concerned. So incentive fees is 0. And the only fees that will be paid is management fees, and the investor's return is actually going to be negative because they started off with 242.8 and they ended up going down to 220, and after subtracting the management fees, that's a negative return of 11.2. Now let's say in the third year it goes to 256. So let me draw this. From 200 you went to 260, you paid a certain fees, came to 242, and then you came down to 220, and then after the adjustment of the fees, you came down even more, and then they are saying you went up. Right now you've gone up to 256. You've gone up to 256. Now 256 is above that watermark which had been set of 242, right? So there is going to be some fees. There is going to be some fees. And how much is that going to be? It's going to be 256 minus the 242 and 20% of that. So this is going to be your incentive fees. You'll have your management fees of 2%. So you add those two, 512, which is 2% of this, and 2.64, which is 20% of this difference, and that's your fees. And you end up with 256 minus the total fees, and that's how you get your return. Now the question is, where is this 215 coming from? This is that 220 minus the 4.4 fees of last year. So let me just take you back again. Last year what happened was that you ended up at 220. There was no incentive fees, but there was a management fees. So this 220 minus 4.4, 220 minus 4.4 is 215.6, right? So that's where you kind of 215.6. That's where you ended the second year after subtracting the management fees. And then the third year, fund size went to 256. The management fees and the incentive fees were subtracted, and then as a percentage return, you're going to calculate it based on your starting balance for the third year, ending balance for the second year, and you find out that the return is 15% for the third year. Right, let's have a look at a fund of fund double layer of fees, right? So we'll look at directly investing in a hedge fund. Obviously that will be better, lower fees. And then we look at investing in that fund through a fund of funds. So there will be a double fees here. So if you directly invest in the hedge fund, it's going to be a 2 and 20. And if you want to go through that fund of fund, there's going to be another layer of 1 and 10. So let's see both of them. Let's do the direct one first. That you are having 25% profit of 200. So the fund is going from 200 to 250. So there's a 50 million profit. And you're going to pay management fees of the beginning assets under management into 2%, right? And why beginning? Because it clearly says over here, management fees are calculated on an annual basis on assets under management at the beginning of the year. So you have to be careful with this, right? If the question says beginning of the year, you do management fees based on the beginning of the year assets under management. If it says ending, it will be ending. So whatever it says, that's what you have to do, and that's how the management fees part is calculated. Then the incentive is going to be 20% of the profit, either before deducting or after deducting the management fees. Clearly in the question it will tell you. If it says that management incentive fees are calculated independently of management fees, so here you can see management fees and incentive fees are calculated independently, which means we don't need to deduct the management fees before calculating the total profit amount on which we will get the performance fees. So we take that entire 50. So 20% of 50 is 10. That's the incentive fees. 2% of 200 million is 4. That's the management fees. So you've got your management fees, you've got your incentive, also called carried interest, also called performance fees. And then you minus those two from the profit because the investor will lose this amount because of fees, and what you have is 18%. Now, if the investor were directly investing in this hedge fund, they would earn 18%. If, however, they go through the fund of funds, now the fund of fund would earn that 18%, and then they would charge you management fees and incentive fees on top of that, right? So that 18% in currency terms is 36 million pounds. How? 200 million into 18% is 36 million, right? So that's the profit this fund of fund would have gotten from the hedge fund. And they would say, okay, give us 10% of that. So 3.6 million. And they would also say, give me 2% of the assets under management. No, not sorry, 2%, 1% of the assets under management. So 200 million into 1%. So the 2 million is the management fees of the fund of funds, 3.6 is the incentive fee of the fund of fund. And from the 36 they got from the hedge fund, this is also going to be subtracted and the investor gets only 15.2. So clearly it's better to directly invest in the hedge fund, but practically speaking, investors don't know which hedge fund to invest in, right? So that's why sometimes they go for that fund of fund option. Now, another very interesting concept is survivorship bias and backfill bias. So what happens is, see, hedge funds are not as heavily regulated as your normal other mutual funds. So they don't really have to report data. And a lot of them, they don't report the data if they are not performing very well. So what happens is, let's say this is you in the year 2000, right? And you don't know which funds are going to do well. So there's A, B, C, D, E, right? But this is you in the year, let's say 2024. Now, the ones that have survived are C, D, and E. C has made, let's say, 10% per annum. D has made 20% per annum on an average basis. E has made 15% on annum on an average basis. And you're like, wow, hedge funds do pretty well, right? But the old you didn't know which ones were going to do well. So if the old you didn't know which ones were going to do well, what we should see is how all of them have done, right? We should also look at A and B and their performance and then see overall how hedge funds have done. But A and B are not reporting their data because they've not done that well, right? So only the survivors are reporting the data, and therefore it kind of looks good that the returns seem to be overstated, right? So this overstates the returns when the reality is that some of the funds didn't do that well and you wouldn't have known which one to buy or invest in back then. So this is called the survivorship bias. Backfill bias is that, let's say a new fund comes in, right? Let's say F comes in now and you don't know what should be the data that you put in it in its history. And again, you put the data of C, D, E, and E only because that's the one you have, right? So again, even F gets overstated. So that's the backfill bias. Let's have a look at that clawback provision. So this is also very interesting. And again, with the discussion, let's say you start off with 200, you go to 260, right? And then whatever, after fees, you're at 242. And then instead of going up, you go further down. So what we saw was that the investor was not paying any fees, but also not taking fees back from the fund manager because they paid for this improvement and now you've lost that improvement. So if there is something called a clawback provision, then that means that the investor can take the fees back, they can claw it back, right? So how that happens is, and let's take this example. Let's say there is a company A, 5 million invested in that, company B, 5 million invested in that, so 5 million in each of those. After 1 year, company A returns 8 million. So your total 10 million investment has gone to, this 5 million has given a profit of 8. So that means 5 plus 8 is 13. And you're assuming, let's just assume that your company B is still at 5 because we don't know what that is at right now. So that way you've kind of gone up to 18, right, from 10, which means you can get 20% of that additional 8, which is going to be 1.6 million. Now what's happening is that 2 years later, company B turns out to be completely bust, which means if you minus from 18, if you minus 5, you come down to only 13, right? Because this 5 is not there anymore. And then you're like, hey, I'm not at 18, I'm at 13. Why did I pay them a profit? Uh, why did I pay them 20% for the entire 8? I should have just paid them 20% for just from 10 to 13, which is 3. So 20% into 3 million is 0.6, right? So you've paid them 1.6 when you should have just paid them 0.6. So you're going to say, hey, give me that 1 million back, right? So that's what the clawback provision is. And let me show you the solution as well. So let me make some space for it first. And there you have it, right? So initially what happens, you go up to 18 because 5 and 5 is your original investment, which is 10 plus the 8 million profit. So that 8 million profit, you pay them 20% of that, which is your 1.6. But then later you realize that, hey, 5 million has been lost from that 8 gain. So actually the gain is only 3. And therefore you should have paid them only 20% of 3, which is 0.6. So then you say, okay, give me back that 1. And that is the clawback. And usually what happens is if there is a clawback provision, right, all the profit incentive fees is held in an escrow account. So this would be typically held in an escrow account, which means it can be reversed. The GP, the general partner, doesn't really get their hands on it until a few years later. So it's held in an escrow account. So that is it, guys, for this very interesting reading and some interesting calculations. Of course, as I was telling you, that you need to work through these problems yourself. So go to the CF Institute website, learning ecosystem, go to the practice area, knock yourself out with a bunch of questions. Use our question bank to do that, but you have to practice, right? You have to practice. Make sure you get enough practice of management fees being applied to the beginning assets under management, ending assets under management, performance fees being calculated, net of management fees or independent of management fees. And you can have a clawback provision, without clawback provision, waterfall, deal by deal, European. And you can also have your hurdle rate, soft hurdle, hard hurdle. So make sure you get all those questions done. Right. So let's have a look at the summary. We talked about alternative investments being different from your traditional investments. They have non-normal risk return profile, so asymmetric, right? Could be negatively skewed. Transparency is less, liquidity is less, complicated product and fee structures are there. So we can't really use your traditional return measurement tools that we have for traditional. So here, okay, you use one of the traditional ones, which is IRR, but you also use some new ones, which is MOIC and the cap rate. So we looked at that. Right. And then we said, okay, how else can we evaluate the returns? So we got into so many different types of calculations, and you need to be able to do those. Right. We also talked about how hedge funds kind of incentivize investors to agree to lower liquidity terms and invest bigger amounts. Also, maybe consider getting in early. So that's the founder share. You can even have either or, which means no management fees, only performance fees. But that, of course, assumes that the year is very good. In bad years, there will be management fees, but it will be a smaller amount. And that is what we've talked about, right? Again, every investor is different. There could be side letters. So you have to really get into their letter and see what are their terms and what they have earned. And finally, this is all subject to survivorship bias and backfill bias to make sure that you don't fall prey to those biases. Right, guys, thank you very much and hope to see you in the next learning module.